Picture this. You're sitting in your living room, checking your bank app. That savings account you've built up maybe for a house, retirement, or just a rainy day it's earning a tiny 2% interest. Feels safe, right? Solid. But what if I told you that money is just sitting there? It's quietly funding a $38 trillion monster. And in return, the system is designed to erode its value, year after year. Welcome to the trap. Let's rewind a bit. It's 2025, and America's national debt has blown past $36 trillion, racing toward $38 trillion by the end of the year. For context, that's more debt than the combined economies of China, Japan, Germany, and India. But numbers like that make our eyes glaze over. So picture this. If you laid out $38 trillion in single dollar bills, end to end, that line of money would wrap around the earth over 150,000 times. It's absurd, isn't it? Yet here we are. Why does this matter so much, right now? Because we've hit a tipping point. For the first time ever, the U.S. government is spending more on interest payments over $1.3 trillion a year than on national defense, more than on Medicare. Think about that for a second. We are shelling out more money, less to service old loans, than to protect the entire country or to care for our elderly population. This isn't just a glitch. It's the beginning of a spiral. Here's how it unfolds. Governments don't budget like you and me. Most of their spending is locked in things like Social Security, Medicare, and the interest on the debt. These aren't optional, they're mandated by law. If a politician tries to cut them, they face a massive public revolt. So, when tax revenues fall short, what do? They borrow more. But borrowing money just to pay the interest on your old debt, that's like maxing out a new credit card to cover the payments on your old ones. The debt grows, the interest swells, more borrowing follows. It's a feedback loop, accelerating quietly until it threatens to consume everything. For years, economists used to wave this off. Deficits don't matter, they'd say. We owe it to ourselves, or growth will fix it, but that was the hype. The reality, economic growth isn't outpacing the debt anymore. We're now borrowing about $2 trillion every single year just to stay afloat. And the math starts to get really uncomfortable, really fast. There are only 3 ways to escape a financial hole this deep. First, there's austerity. This means slashing government spending by about 30% across the board or hiking taxes by 40%. Can you imagine your Social Security check getting cut by a third? Or your income tax suddenly doubling overnight? No politician will touch that. It's career suicide. Second, there's default. Just stop paying. Countries like Argentina and Russia have tried this. But for America, it's a different story. U.S. Treasury bonds are the foundation of the entire global financial system. If the U.S. defaulted, banks worldwide would crumble. Credit would freeze up. Economies would tank. It would be financial Armageddon in pinstripes. That leaves door number 3, the soft default. This is where you pay every single cent you owe, but you pay it back in dollars that are worth far, far less. In other words, you inflate the debt away. History is full of empires doing exactly this. Ancient Rome debased its currency by mixing cheap metals into its silver coins. Weimar Germany famously printed so many marks that they became worthless. And post-war Britain allowed the value of the pound to wither away. It works because it's sneaky. There are no scary headlines about budget cuts or a national default, just the slow, creeping rise of prices. Your savings shrink, but it happens so gradually you might not notice until it's too late. America actually pulled this off masterfully after World War II. In 1945, our national debt hit 119% of GDP, the highest it had ever been. Instead of taxing everyone into poverty, the Federal Reserve capped interest rates at just 0.5% while letting inflation run at an average of 6% per year. So, people who held government bonds got paid back, sure, but the money they received bought less and less each year. Over a decade, they lost about 40% of their investment's real value. The national debt to GDP ratio dropped to 66%. Not because we paid it back, but because its value was eroded by inflation. Back then, the rules trapped savers. Banks weren't allowed to pay more than 1% on deposits. Capital controls made it nearly impossible to move your money overseas. Your cash had nowhere to hide. Today, the tools being used are slicker, more insidious. First up, captive buyers. In a truly free market, for anyone to lend the government $38 trillion, they would demand sky-high interest rates, maybe 8%, 10% to justify the risk. But that would cause the government's interest costs to explode to over $3 trillion a year, more than all federal income taxes combined. It's simply unaffordable. So, the system forces certain institutions to buy the debt. Regulations created after 2008, like Basel III, mandate that banks must hold high-quality assets. And guess what qualifies? U.S. Treasuries, by definition. So banks have to buy them, even at terrible yields. The same goes for insurance companies and pension funds. Regulations demand they hold these safe assets. The result: over $12 trillion in debt is snapped up, not because it's a smart investment, but because it's required. The money in your bank account, it's being invested in these bonds. Your pension fund, same story. The very institutions holding your cash are forced to lend it to the government at rates that guarantee a loss after inflation. The irony: these rules were sold to us as a way to create safer banking. Safer for whom? Next, we have the rigged inflation gauge, the CPI, or Consumer Price Index. The CPI number drives everything, from Social Security adjustments to the payout on inflation-protected bonds. But it's subtly manipulated. For example, it uses something called substitution. If the price of steak jumps, the CPI model assumes you just switched to chicken. So, officially, inflation goes down. But your quality of life, it's diminished. Then there are hedonic adjustments. If a new phone costs more, the government might deduct part of the price increase, claiming it's for better features, like that new camera you didn't ask for. They also adjust the weighting of different items, so things with rising prices have less impact on the final number. The net effect is that the official CPI understates real-world inflation by at least 2-3 percentage points. Websites like Shadow Stats, which use the original 1980s methodology, show inflation is often double the reported rate. Over several years, this manipulation can have the real purchasing power of your benefits. You get paid in full, but it's a lie. Finally, there's the concept of fiscal dominance. The Federal Reserve was once seen as an independent body that fought inflation, even if it meant hiking interest rates and causing some economic pain. Not anymore. The national debt is simply too big. If the Fed raises rates high enough to truly tame prices, the government's interest payments would explode, risking a default. So, the Fed is forced to bow to the government's needs. In 2020, it printed nearly $5 trillion to buy up government bonds, directly funding deficits. As major foreign buyers like China and Japan sell off their U.S. Treasuries, China's holdings have dropped from $1.3 trillion to around $770 billion. The Fed is becoming the beer of last resort. It keeps interest rates artificially low, which fuels inflation and creates bubbles in assets like stocks and homes. Your 401k might look like it's growing, but when you adjust for the real cost of living, it's mostly smoke and mirrors. When you zoom out and look at the big picture, this isn't just about economic policy, it's a massive wealth transfer. It's a transfer from savers to spenders, from you to the government. Your savings account might earn 3%, but if real inflation is chewing away 6% of its value, you are losing 3% every single year. In a decade, that's nearly a third of your savings gone. You are the lender, and you are footing the bill for decades of unchecked borrowing. The hype they sell you is safe assets. The reality is a slow, steady bleed. But here's the skeptical take. Can they really pull this off again? The post-World War II strategy worked because the entire world needed US dollars. Today, there are alternatives: rising digital assets, gold, even foreign currencies and bonds. People are waking up to this game and are starting to shift their assets. If inflation were to spiral out of control like it did in the 1970s, interest rates might be forced to soar anyway, no matter what the Fed wants. The trap is tightening, but cracks are beginning to show. So ask yourself, are your savings really building security for your future? Or are they just propping up a system that is fundamentally rigged to devalue them? The clock is ticking, and that $38 trillion debt, it's not going away quietly. Thanks for watching. If this got you thinking, make sure to like, subscribe, and hit the bell for more content that looks behind the curtain.